And then the final thing is that I'm going to add here is the executability. Okay, big word. What it means is how easy or hard is it to execute a system like this. Okay, and I want to illustrate this. Let me come up here, kind of a clean space here, and I'm going to do this. I'm going to draw something out here. We'll kind of make it pink, make it big. And I want to talk about this as a spectrum, okay? Not as a linear line going from one place to another, but think of it as a spectrum. And over on the left side of this spectrum, you have discretionary trading, okay? Discretionary, if I can spell it right. Discretionary. And discretionary trading is something like, I feel like price is going up here. Okay. And therefore you're going to pull the trigger and you're going to take a trade because you just feel, or you have an intuition, right? That's fully discretionary behavior. You're just making a decision in the moment on, whatever, right? Whereas over here on this side, you have mechanical. And the kind of the ultimate mechanical entry would be a bot, okay, or an algo that you create, where it's fully automatic, fully automated. You don't do anything. There's no decisions. It's just a set of rules, and boom, you're off and going. And I want to do this. I want to put like a divider line somewhere here. So let's just put this divider line in here. Okay, something like this, right? And often as traders, we are usually somewhere along this spectrum, okay? We're never really far out here. If you are, you're probably not doing so well in your trading, or you're just getting incredibly lucky. And if you're here, you're probably a quant, right? As day traders, most day traders live somewhere in this middle zone right here. And in fact, I would say that most day traders live probably over here on this side, a little bit more left of the middle toward the discretionary piece. Most traders that I run into. In fact, most traders that I run into that are struggling are over here. So what this left of center looks like is you're trading, you're zoned in, and you're looking at your charts, and you have maybe 3 out of 6 signals that are triggering, or maybe 3 out of 9 signals that are triggering, right? And then a few more trigger. And then you have to make a decision whether or not you have a trade or not. It's not necessarily crystal clear. You may not have all your A+ criteria, and you might actually have, an A trade, a B trade, a C trade, right? You might have all this flexible criteria to help you to know that, okay, it's okay to take something that's not quite right. But the more decision making you have to do in the moment, whether or not you have a trade at play, the more discretionary your approach is. When you move over to this side and you're more on the mechanical side, your rules are so incredibly clear that there's no decision making in the moment. There's just, oh, yeah. You might have a couple rules missing. You might have 8 out of 10 or 7 out of 10, right? But you really have a lot more clarity that you have a signal that's telling you to get in. And so the discretionary aspect starts to melt away the more mechanical you are. And so when I talk about where does data flow live on this spectrum, it lives very much on this side. Very much on this side. And because it is tied to how the market is currently structured, then it has the staying power that most mechanically oriented systems don't have. It's not a fully mechanical system. There are some decisions that have to be made, but it is night and day between, something like a moving average crossover system that sits over here and data flow over here. It's a very different approach between being more mechanical versus being more discretionary. And so that's what I mean back here by the executability of the system. How hard, how difficult, or how easy and simple it is to execute your approach. And I found that when you're doing data flow, you have such incredible insight and understanding of all 5 of these elements. And that's what helps to create the consistency. So let me use one trade example to illustrate these 5 advantages of data flow in action. And I'm going to use gold, but this works across many different futures contracts. This is gold from Thursday, September 19th, 2024. And we come back to our same scenario that we were just talking about. And, depending on your strategy, you might have a signal to go long here. You might have a signal to go short here. You might have all kinds of other levels. I don't really care about anything else. I care about data flow. What is data flow telling me? And so I'm going to turn on some of the tools that we use with data flow. The first one is our DR, IDR levels. And these are levels that tell me what's happening from a range perspective across the 3 main different sessions we have. We have the Asian session, we have the ODR overnight session, and then we have the RDR, which is the session we're going into for North America. Okay. And so using other tools, I might have a bias based on statistical probability that we're going up or we're going down at this point. I don't really know. I'd have to look at what those tools tell me. But that's another type of setup here that I'll kind of go into a little bit later as part of the 5. But I'm only worried right now about this one setup called time and price. Okay, so this is a time and price setup. Okay, that's what we call it. Let me give it a different color. Okay, this is time and price. And in time and price, there's a few aspects that distinguish itself. One is it waits until 10:30. Okay, so let's put this on. So 10:30 start. Look for direction. Get retracement levels. Get targets. That's it. This is all it does right here. These things right here. You wait until 10:30. After 10:30, you can get a signal for directionality. You'll get retracement levels, and then you'll get your target. So let's move ahead. We'll kind of jump over here to 10:30 and see what happens. Okay, so now we arrive at 10:30. And exactly at 10:30, we get 2 things that happen. One is, it's our 10:30 start, so we can begin looking for directionality, and we have our directionality trigger. So because we went above, and actually we closed above this level right here, now we're looking long. In fact, one of the aspects that we do, in fact, when you look at the data that we have, price only has about a 20% probability of after it closes on one side of this range, only a 20% probability that it will close back below the other side, that you'll get a close below here. Okay. And so we usually have about an 80% probability that this level here, down here, will be respected through the entire trading session. So we have a high degree of confidence that we're looking to go long at this point. One of the ways that we use statistics in our favor. Okay. Now, the next thing we need our levels. And so a lot of our data is actually stored in external programs. So these are programs that are built on Python. They're web-based. They look at 16 to 20 years worth of the data. And for this scenario today for gold, it will spit out, these are the actual levels that we're looking for. And we've coded indicators to help pull in those levels for us. And so we can turn on one of our indicators that's looking at our levels. And now it gives us a number of different levels. Okay. And the levels are our retracement levels. Okay. So these boxes here, these are our retracement levels. So if price comes back into this zone or this zone, we're expecting a move up to here or to here. These are our target levels, okay? That's one target and that's two target. So this happens to coincide with these levels here, but this isn't here because these are here. This is here because there's statistics in our data that says this is the median value of how far price went on a day like today. Okay. So we have, what do we have so far? If we take a look at our list, okay, we have directionality. Okay. We know we're going long. We have our entry levels. Okay. We'll talk about time in a second. And we have our target levels. Now, time is interesting. There's two aspects of time here that we track when we're looking at a time and price trade. Aspect number one is when we can begin to engage in a move, and that is after 10:30. But there's also a maximum time by which we want to be looking for retracements. Okay, so if I remove all of these things, clear it up, kind of get it back to what we were looking at, notice that we have kind of this line right here. Ignore this line right here for now, but look at the edge of the box right here, and then this edge of the box right here. This coincides with 11:10 a.m. Eastern time. And what this means is that if the retracement, this pullback, doesn't happen before 11:10 a.m., we have a very low probability that afterwards, after that time frame, if it does pull back, that it will go back up. And so now, not only do we have a time for when we can start our trade, we have a clock ticking as to when we can actually execute the trade. So we have these really great features around time that's part of data flow. So now the question is executability. How do we actually execute this system? How do we execute this in a way that lends itself to being more highly mechanical versus something where you have a lot of discretion? Well, first of all, a lot of the discretionary decisions have already been removed. You already know time, you know levels, you know where targets are, and then it's a matter of how much risk reward am I putting on, which hopefully you have a trade plan, and so that shouldn't be discretionary. And then your stop loss rules, which if you've done the work to look at time and price and back tested it, then you should already have a set of rules for that as well. So there's a couple different options on how you can make this executable in a way that's very mechanical. Option number one is you place limit orders on the edge of your levels. And so maybe that's limit order number one. And so you're willing to go for, you've got 3R to your first target and you have almost 6R. And I always like to front run a little bit just to make sure that you get hit, So you've got about 6R. We'll actually stick to our rules here. So 5.5R. Sorry, let me get this right. There you go. I want to get it perfect for you guys. All right, so like 5.9R to the median. Okay, so that's one option, which is you just take a limit order, and if it comes down here like this, you want it to tap and then you want it to go, right? Now, unfortunately, it doesn't always tap and go, right? Sometimes it might blow through it. So, you might actually do something like this all the way down to here, and then it goes. So what do you do then? Well, you take your loss, your 1R loss, and then you add this right here. Okay. And maybe you have a rule that you give this a little extra wiggle room and extra space. So, the first trade's dead. The second trade, it comes down, holds here, and then goes back up. And what you have is you now have an 8R trade at hand going up to here. Or you can just go to the mode, more conservative, get 5R. So you'd be net 4.5R just to the first target, or 7R all the way up to the second target. That's with just one approach. I actually teach a couple of different approaches for making this executable, but that's one approach, very simple approach. So what's the worst that can happen? Well, the worst that can happen is this thing blows through both levels, comes all the way back, blows through all of it. You've taken a trade here, right here. That was a loss. You took another trade right here. That was a loss, right? And you had 2 losses. So you're down 2R where you had an opportunity to make up to 8 or up to 7, right? That's good risk management. That's really great risk management. You're risking 2R for the potential to make 7. I'll take that any day of the week with probabilities in your favor on your setups. So that's what we're looking at. So that's option number 1, is to kind of take these kinds of limit trades. Let's see what happens for this day. So we're going to target our median here because I don't like to go for just 3R usually. I like to go for a bit more. I don't remember exactly where we were. We were somewhere around here. I think we were, yeah, something like that. Something close to that. So we come down. We are triggered in our trade now and our level held. And now we move. And then what I coach on is when we get to 2R, we can move to break even if we want, or we can let it run. It's our choice. And we come all the way back up to here. And just notice afterwards, you know, we kind of just dink around here at this particular level. Don't really do much after that. But that was a 6R trade. We risked the potential for the day of 2R. We ended up with 6R on this trade, which is awesome. This is why I love this approach. It gives me really strong probabilities of the direction we're taking, the levels that we're going to be retracing to, the time frame by which I need to be paying attention and focused, the levels that are magnets, and it is easy to execute this system. It's fantastic.